Hey everyone, welcome to another episode of the Questioning Behaviour podcast. I'm one of your hosts, Merle van den Akker, and I'm here with my lovely co-host, Sarah Bowen.
Hi.
You're the dummy that don't believe in science. All your projects always be denying. You're the dummy that
Today, once more, we're diving into the world of finance, specifically, what the behavioral science is of investing money. And not just any type of investing, we're going to look into the algorithms underlying investments protocols. So strap yourself in, because this is going to be a wild one.
That's one wordy introduction. Good God, I hope you're all still listening.
I tried my best. But today we're talking to a guest who I know quite well through a friend of mine. So I know him through Bruce Regal. And we've talked about, the differences between active and passive investing for a bit. And he has actually developed his own investment portfolio called Rose Valley Funds, where he's applying behavioral science to an algorithm to make sure that you're actually, that you can beat the market, which is, of course, the goal of active investing. And wow. I feel like, I know it's a lot. And I feel like, given that we've done an episode before with Greg Davis, which honestly I really, really enjoy doing, but it's become quite clear that Sarah and I are absolute noobs when it comes to active investing, and in Sarah's case, when it comes to passive investing as well.
Yeah. True.
So I feel like maybe we're better off just immediately diving into this episode and just listen to our expert. And our expert of today is Wim Steemers, who I have the very pleasure to introduce. So let's dive into it. So today we are actually talking to Wim Steemers. So please, Wim, do tell the audience, who are you, what do you do?
So, yes, Wim Steemers. I live in Sydney, where I work for a family office as a portfolio manager, which makes me a professional investor. And I've been in this field for 20 years now. Before that, I was in management consulting. I had my MBA from the University of Chicago School of Business before that. And before that, in the mists of time, I studied both law and astronomy at Leiden University in the Netherlands.
Very nice.
Nice switch.
Why law and astronomy? It's
a good question.
Yeah.
Why law and astronomy? Astronomy because it was my interest, my hobby in my high school days. Law because I wanted to be a little bit broader than astronomy. Astronomy is, very interesting. Still feel that way about it. But as I thought at the time, it is very, very specialized and very, very narrow by necessity, right? Because there's so much to learn, but it goes so deep. And I figured that's not what I wanted for all my life. So law gave me, in Holland, as you maybe know, Merle, in those days anyway, if you didn't really know what you wanted to do with life, you studied law, right?
This is true.
It may still be true today.
Yes.
Maybe. So you went from in Amsterdam studying, I guess, what you were passionate about, to going to Booth, to investment. What did you follow the money? Was this the start of your career path? Is there more to it?
Well, maybe that was the hope. No,
I see.
No, look. After I finished in Leiden, I decided business school was an interesting next step. So that would, as I was hoping at the time, open up the world of business for me. And a very common next step after that was to go into consulting, and I did that. I was with McKinsey for a while, was with another small consulting firm for a while. And that, after a number of years, working, 60, 70, 80 hours a week, at some point that was enough. And then the switch from there to investing actually was a relatively natural one as well. A better work-life balance, but still the interesting bits of analyzing businesses, analyzing companies, trying to understand what makes them tick, trying to understand their strategies, and who will be successful, who will not be, and so on and so forth. So it's a little bit more logical than it might seem at first when you think about it that way.
Sure. But then I'm also curious about the transition. So obviously the title of this episode is about behavioral investing. So you became an investor. So far, so good. So then how did you roll into behavioral science? What triggered your interest?
Well, we'll get into this later, I think. But now that I know a lot more about behavioral finance, behavioral science, I can see that I've actually always been a behavioral investor. And we'll get into why that is. And I would argue that most people are, even though they're not aware of it. So putting that to the side for a moment, about 2 years ago, I had some free time on my hands. I was between jobs, as they say. And I used that time to start to think about putting a portfolio together, which up until that time I had mostly looked at individual companies. I hadn't done a lot of work at a full portfolio level, and I thought it'd be interesting to kind of look into that a little bit more. And then a mutual acquaintance of ours, Merle, Bruce Regal, whom you know well and who I know very well, he was studying behavioral finance in Warwick at the time. You probably know him too, Sarah, actually, come to think of it.
Bruce, how could I forget you?
Anyway, Bruce and I had a number of conversations, and I don't know whether it was him who pushed me in that direction or me asking some questions around it. But anyway, I started to actually dive deep into the academic literature around behavioral finance, and I explored the link between behavioral finance and how that actually affects asset prices, and whether you could or could not make that a quantitative link rather than a qualitative link. It's another thing we can get into. A lot of people are aware that, so just as a very broad example, investors overreact to bad news. We all know this, or behavioral finance tells us this. So therefore, let me go look for stocks where some bad news has happened and the price has fallen, and I'm going to look at a bunch of those stocks and see whether there's a good investment opportunity there, right? So that's what I would call a qualitative use of teachings of behavioral finance. What I was interested in 2 years ago was, well, can I make that more quantitative? And it wasn't, as it turned out, I was able to do it, and it wasn't necessarily looking at bad news, but again, we can get into more detail, but taking some of the very specific lessons of behavioral finance and putting that into an algorithm to put a portfolio together was something which I've done, I believe, successfully. So far so good. That obviously we won't know until 5 or 10 years has passed, but I'm off to a good start there anyway.
So this is quite a new development. Is it still, you're not sure whether it's going to work as well as you think, or have you had some good feedback so far?
Well, look, so I, of course, am very confident that it's going to work as I think, right?
Would you say you were overconfident?
Yeah, overconfident maybe. Look, so how does this work in the investment world, right? So maybe we just need to back up a little bit and for your listeners kind of explain the structure of the investment world and what bits and pieces we're talking about here, right? So first of all, we're talking about investing in the stock market. It's probably applicable to other asset classes, but specifically that is what we're talking about. And that if it is applicable to other markets, it's probably more applicable to stock markets because they're more liquid, more traded, et cetera, et cetera. So now, people investing in the stock market, there are, of course, individuals who who do this. Most recently we've seen a lot of individuals doing it through things like Robinhood, which is a whole other thing we can talk about. Other individuals who do it. It is, however, a difficult thing to do, and so there are professionals who do it as well. And these professionals, of which I would count myself on, generally the way you organize it, you put a fund together, and then you make the fund available to individual investors. So, that could be mom and pop, investing in a Fidelity fund or a Vanguard fund or whatever it is. Or it could there could be another middleman there. It could be a pension fund, right? So people put money in a pension fund. The pension fund then chooses an asset manager for a specific stock fund, right?
Yes.
So now these stock funds, they generally run along the lines of you have a portfolio manager who makes the decisions, who is supported by a number of analysts who do research on particular stocks. So, let's say the fund has $1 billion in it. There's a portfolio manager and, maybe 5 or 6 analysts, and they divide sort of the whole stock market, the stocks in the stock market between them. So you do transportation stocks and banks, and you do insurance stocks and tech stocks and so on. They come with their recommendations to the portfolio manager. The portfolio manager then makes a final decision and says, I'll put 5% of my fund in this stock and 2% in that stock and 1% in that stock. And then those decisions are updated all the time. And then hopefully at the end of the year, you say, on average, the market went up 10%, but because I chose these stocks and I didn't choose those, my fund went up 12%, and then you've done a good job, right? So that's the world I live in, so to speak, right? So the aim here is to put a portfolio together to pick the right stocks that hopefully at the end of the year do better than the market average. Now, in addition to doing it with a bunch of analysts, you can do it with some kind of computer algorithm, right? Or sorry, not in addition, sorry, like as an alternative to that, you could do it with a computer algorithm. We call it quantitative investing or a quantitative model. Now,
so you want to get rid of people? Is that the goal? Like, do people make mistakes? Want to get rid of them in the process?
So that's one way of thinking about it, yes. And I think that's probably a very powerful reason as to why people go to quant investing. And actually, in the framework of behavioral finance, you can actually use that argument, make that argument even stronger than it's been before we knew about behavioral finance, right? Because the analysts that are coming to you with their ideas, they have the behavioral biases and use the heuristics, but the portfolio manager does that as well, right? So there's a lot to be said for quantitative investing. Now, I would argue that the quant models themselves, it's a bit of an illusion to say, there's no human input there, because the model itself, of course, is the outcome of the programmer or the quantitative analyst putting it together, and there are very much human biases in that model as well, right? So, but anyway, that's another way of doing it. Generally, whichever way you do it, you put something together, and then to actually sell it as a product to investors. So be it the pension fund or be it to mom and pop individual investors through some advertising, whatever. Generally, people will say, it's all very interesting what you tell me, but show me that it works. Show me a 3-year track record, right? So, Sarah, that's a very long answer to your question. Do I believe that it works and that it will work? Yes, I do. But I need a 3-year track record to convince other people. Now, I'm almost 2 years into it, and the fund has performed exactly as what we call the back test would suggest it should. So the back test is where that really only applies to quantitative models or to algorithmic investing, which this thing I put together is. So the back test is where you say, here's my algorithm. If I had done this for the last 10, 15, 20, 25 years, this would have been my result. Right? So the back test says, this approach should give me 10% better than market returns per year on average.
With a lot of hindsight.
Yes.
Right, exactly, right. But of course you try to put the algorithm together such that you say, well, in December of 1995, this is the information I would have had then, and this is the decision I would have made then. How would the fund have done in 1996? But you raise an interesting point. So, what one of the pitfalls, one of the things that people who put these models together always worry about, including myself, is are you somehow making a mistake, and that somehow in a way that you're actually not aware of, some knowledge, some data of 1996 has sort of crept into that December 95 decision point, right?
It's a good question.
So it's called hindsight bias, right?
Yes, of course.
Exactly.
That would be quite problematic if it turned out that the information that you couldn't possibly have had then is creeping into your model of now. Right. I can imagine that would be quite the problem. But I'm actually quite curious. So discarding hindsight bias was if we had invested into the stock market, say about 2 years ago when you hypothetically started, and it would have performed, then of course we know as people that we've got a lot of biases. And at least people who have studied any type of psychology, behavioral science, what have you, known that, our judgments aren't as optimal or rational or whatever you want to call it as could be. And of course, the stock markets are not exactly an exemption. So my question then is, what is it that you need to account for? Like, which bias is predominantly just raging rampant when it comes to investing?
Let me give you a quick answer about the Rose Valley funds, and then a broader answer for kind of a more generally. So the Rose Valley funds that I put together, they really are based around two biases. So out of the whole, a universe of biases, I picked two, and I was able to put that into a model. And the two are mental accounting. So this is where the rational theory says you should look at your portfolio at the portfolio level. The reality is investors look at each stock that they own individually, and they evaluate, I'm making money on this stock, I'm losing money on this stock. Again, rationally, that's irrelevant. The only thing that's relevant is how's your total portfolio doing, and what's the risk, the aggregate risk in the portfolio. But that's mental accounting says people don't do that, right?
Sure.
For your listeners, another example, a good example of mental accounting that you may be familiar with is you save money for your next holiday. You put away $100 every month, and you put it in a special holiday bank account where you're being paid 0.5% a year. At the same time, you have a credit card where you roll over the balance and you pay 20% a year, right? It's utter madness, clearly, right? And yet,
yes,
we all do it, right? So that's mental accounting. The other one is prospect theory, which is sort of really one of the very basic things of behavioral finance. So this is where people, where the psychologists found out that people suffer, they dislike a loss more than they actually like a gain, or the pain they feel. The pain that you feel from a loss is more intense than the pleasure you feel out of a gain. that pain or gain, so that pain or pleasure from the gain or the loss is felt relative, obviously, to the price that you bought the stock at, which is then called the reference price. And so if you put together mental accounting and prospect theory, what you get is what's called the disposition effect. So what happens is, let's say a stock trades at $30, and that's the right price, if there is such a thing, but it accurately reflects the future of the company, right? Now the company comes out and says, I lost a contract, that was going to make me money in the future. That contract's lost. I'm no longer going to make that money. Let's say the value of that contract was $5 per share, so the new price should be $25. Because of this, people don't like to take the pain of that loss. The stock price does not go from 30 to 25 immediately. Efficient market theory would say it does. A prospect theory and mental accounting says it doesn't. That's what the portfolio takes advantage of, right? So you can mathematically work through based on that effect at any given point in time, which stocks stand to go up in the future and which stocks tend to go down in the future. Right? So that's kind of the narrow answer to your question, particularly for the Rose Valley portfolios that I put together.
Okay.
The broader part to your question, which I find, so that's kind of my other activity as a portfolio manager with a team of analysts, the more traditional funds management approach. How do you deal with behavioral biases in that context? And to me, this is actually one of the most interesting things that I learned in studying behavioral finance. You would have thought that if somebody teaches me about anchoring, for example, right? Anchoring is a very interesting one. So again, just 30 seconds. What is anchoring? I tell you, Manchester United football team is 100 years old, and I'm asking you, how old was Gandhi when he died?
Sure.
I'm telling you, Manchester United team is 75 years old, and I'm asking you, how old was Gandhi when he died, right? On average, the first group of people will give an answer, on Gandhi's death that's closer to 100, and the second group of people an answer that's closer to 75. Clearly, how old Manchester United is has nothing to do with, how old Gandhi was when he died, but that is anchoring, right? People, they hear a number and they somehow, it somehow makes its way into their brain and influences the answer to the next question. Now I've told you this, I've studied this, I know this about myself. What I find really interesting is I will still fall prey to this bias. There is nothing I can do to stop myself from falling prey to this bias.
Well, it's not a switch you can turn off. Your brain, it's a...
Well, that's exactly right. But isn't it surprising, right? So the analogy I make is, I go out running, I get a running coach, and he tells me I've got wrong form, I need to, walk on my toes more or be more upright, or, whatever it is. I can correct that. I can learn that, right? But here's a behavioral scientist who tells me, you suffer from anchoring, and there's nothing I can do. I will continue to suffer from anchoring. So when you read books about behavioral finance and investing, or you talk to investors, a lot of what you'll hear will be along the lines of, I've learned all these biases and heuristics, and therefore I'm going to try and avoid them. Mm-hmm. And so my answer to that is, well, yeah, you've sort of learned the first part, but you haven't learned the second part, which says you can't, right?
Yeah.
So,
Such hubris.
well, yeah. Now, look, and I'm being probably a little bit harsh because clearly there are a lot of very smart people that understand it quite well. So, what's the answer here? The answer is, even though you cannot stop yourself from exhibiting these biases and heuristics, you can recognize it in others, and you can point it out to others. So what you need to do is you need to create a team, and you need to create a team environment that allows for everybody to criticize everybody else without repercussions and without bad feelings, et cetera, right? So, we finally get to the answer to your question, 15 minutes later. So what I do is I tell the analyst on my team, I don't pay you to agree with me. In fact, the opposite. I pay you to disagree with me. I want you to question everything I say because I know that I have these biases. And by the way, I'm going to do the same thing to you. And I want you not to be offended. And I want you not to be upset. This is the only way we can get to a better than average answer.
Fair enough.
Yeah, I think that's suggests a lot of wisdom, actually. Rather than surrounding yourself with people who are like-minded of the same, or just want to agree with you, actually challenging someone and inviting people to call out when you're acting on your own biases. So I feel like you've already answered my next question, because my next question was going to be, where does the algorithm differ from average human choice? Are there any examples where the algorithm goes in the complete opposite direction than, if we were to put 100 people in a room and they were just to, invest and make decisions? Is there something to do with the fact that the algorithm, I guess, is devoid of any emotional response? Like the algorithm isn't going to feel sad or anxious and then act on those emotions?
Yes, that's certainly a big part of the answer. Another part of the answer is, look, this particular algorithm. I mean, and there are millions of quant funds and different approaches, right? And a lot of them are very valid, and a lot of them are very successful. So this is by no means the only way to do it. Mm-hmm. This is, to my knowledge, a bit unique in the sense that it very explicitly tries to take advantage of behavioral traits of people, right? So and what that does is it kind of, as long as there are people in the stock market who make decisions, biased decisions, this algorithm will do well, right? So it's almost, your question is like, does it work because it doesn't have emotions? Well, it actually goes one step further. It works because other people do have emotions, right? Mm-hmm. It wouldn't work without it. So that's kind of interesting. And it's, what I found interesting. So a lot of quant models, they work by, looking at, taking a lot of data from the past and then saying, on average, stock that trade at a lower price to earnings multiple tend to outperform. So I put that as a factor in my quant model. But you may combine some factors, price to earnings or stock price momentum or price to book or so a lot of things like this. Mm-hmm. What you tend to see is that when there's disruption, when there's turning points in the market, these models struggle, right? So they will do well over the long term, but they'll do poorly when there's great dislocations. And you can kind of see why, right? Because you essentially what you're doing is you put a statistical analysis on a bunch of variables, and you and you analyze the trend, and based on the trend, you make your decisions. That by its very nature will struggle when the whole market deviates from a trend line, right?
Sure.
Right.
The experience with the fund that I've now been running almost over 2 years, over the past 6 months, which has been,
Different.
the most 6 months, in 100 years, it's actually been very good, which was obviously very encouraging. And I could, with a bit of hubris, saying it didn't surprise me. I always knew it was going to work, right? Nevertheless, I was very pleased that it did, right? But again, you could make the argument. I am making the argument. The reason it works is because it's based on human behavior, and human behavior. The principles of human behavior have not changed throughout this extreme market volatility.
Someone might, disagree with that. That's kind of a bold statement. It's almost saying that behavior isn't context dependent. It doesn't matter if we're in a pandemic or not a global crisis. Behavior in the financial market and investing will be the same. Is that true?
Well, no, clearly, yes, so maybe I didn't say it right. Clearly, behavior has changed a lot. Otherwise, the market wouldn't have done what it did, right? But has loss aversion changed? Has mental accounting changed?
Loss aversion might have gotten more extreme. There's a lot to lose for a lot of people currently. Mental accounting depends how your financial situation looked before the pandemic hit, because I'm sure it has an effect on how people are spending their money now, especially if you've lost your job. That's gonna have to have an effect.
But I agree with you, Merle. Of course, people make that, they react to their circumstances.
Mm-hmm.
The question is the bias that they exhibit in that reaction. Is that any different than it?
Well, it could be more extreme, right?
Maybe it could be more.
But
extreme.
I guess there may still be patterns in the way that people respond.
Sure.
Right. That would be my broad argument. Exactly.
Yeah, no, I can see that. I can't imagine suddenly, the average person being risk averse, suddenly a pandemic strikes and they become risk seeking. That I would find very surprising. If your model struggled, then I don't think anyone would be surprised. But I think every model would struggle.
Right. Yeah, exactly.
But I guess I'm curious, because I think this idea of quantitative investing, if that's the correct term, seems really attractive. I guess part of the reason, for me personally, investing is something that I would love to aspire to do, but it's very scary. There's lots of uncertainty, and it's difficult to find the right information on what I should do, because I guess there is no one right answer.
Right.
So is part of the attractiveness of this new method or of these algorithms this idea of accountability, right? If something goes wrong, it's not a person's fault. It's the algorithm's fault.
Right.
And it gives you a rule to follow. You put the information into the algorithm, and the algorithm tells you what to do. Is that part of sort of the attractiveness of this methodology?
That certainly is the marketing pitch, right?
Oh, great.
And so yes, right. So so the marketing pitch would be, here's the algorithm I put together. It's worked over the last 30 years. So therefore, I predict it's going to work over the next 10 years. This is the amount, the level of return you can expect, and there's no subjectivity in that, right? So the debate then becomes, what reason do you have to believe that what happened over the last 30 years is going to repeat over the next 10 years, right? That becomes the debate. And the experience is that they're actually, as I said earlier, in times of disruption, a lot of these quant models don't work, right?
Sure.
And so if for a lot of quant models, there was the popularity of quant models has decreased a bit after the financial crisis of 10 years ago, because a lot of them failed. Right.
Oh,
Right.
Oops.
By the way, there's an interesting statistical, mathematical reason why that happened. And that reason was, a lot of what goes into these probabilistic models, and I'm starting to use jargon here, so forgive me for that. But so, where you base your approach on mathematics that's informed by statistics, implicitly or explicitly, you put expectations about correlation between different variables in there.
Okay.
And when those correlations change, almost by definition, your model will fail.
Sure.
And that's exactly what happened in the great financial crisis. A lot of asset prices, asset classes, different securities that normally had uncorrelated behavior, they started to be highly correlated. And so that just means the premise, all of a sudden the premise of your model is wrong, right? So after the crisis of 10 years ago, the enthusiasm for quant models has waned. I mean, it hasn't gone away, but it certainly has waned a bit, right?
Maybe a bit of skepticism.
Right, exactly.
So I'm quite curious. So far we've mentioned the behavioral scientific input that you have for your specific fund, so Rose Valley, but within quant investing itself, is there a trend towards incorporating behavioral science, or is it just algorithmic, sticking with almost pure mathematics? Or do you think that incorporating behavioral finance or behavioral science is likely to be a form of progress? Is that what the future is going to look like? Or are we just going to dive into quantum mechanics? What are we doing?
Well, so what I would argue, Merle, on that point, it's kind of what I said right at the top of the podcast. In a sense, every quant model is implicitly a behavioral finance model, and I'll explain what I mean with that. So prior to behavioral finance, the belief was, or the theory about financial markets was efficient markets, right? I don't know if you've heard of this, but the efficient markets theory. And me as a graduate of the University of Chicago Business School, I was schooled in that, right? That was religion in Chicago up until certainly when I graduated, long time ago. And what the efficient markets theory says, it basically says, look, every piece of available information immediately finds its way into stock prices, and therefore, past stock prices have no information for you about the future, and therefore you cannot reliably predict stock prices. And so notions like a random walk, that was something that came out of that. So the whole idea of trying to pick stocks and get a better than average return the efficient markets theory sort of says, well, that's a non-starter. You won't be able to do it, right? Because if markets are efficient, then at any given point in time, every stock is trading at its fair value, and so there is no excess profit to be had.
Sure.
Right? If something happens that makes the share price that changes the fair value, like I lose a contract or I sign a new contract, the stock price will immediately jump to that new price, and there's no opportunity for you to actually take advantage of that. Now, I'm simplifying a little bit here. There's a risk element, so it's not quite what I say. It's not, you can get a bigger return, but only if you take on more risk, and so et cetera, et cetera. But broadly speaking, the efficient market theory says you can't really reliably outperform. You can get lucky, but you can't really reliably outperform. Now, the underlying tenet of the efficient market theory, and I think a lot of people tend to forget this or step over this, is the same underlying tenet that is underlying all classical economics, which is the notion that people are rational, self-interested, utility maximizing beings, right?
Mm-hmm.
And of course, behavioral finance, behavioral science, that's the central tenet of behavioral science, is that they're not, right?
Yes. Mm-hmm.
So it's almost, the moment you accept that they're not, you accept that efficient market hypothesis is not a true description of the world, and therefore it is possible to actually outperform in market. And then every approach that you design to try and do that, therefore, almost by definition, is a behavioral finance approach, even if you hadn't called it that, right? But
I see.
Everybody who believes, and trust me, that there is a bit of, it's a bit of religion, there are people who just believe this and believe that, right? So,
yeah.
But, if you believe that it is possible to outperform, you almost, whether you say it out loud or not, it does mean that you believe in behavioral finance and not in the efficient market hypothesis. Otherwise, you wouldn't even try. Right? So,
fair enough.
So as an example, when I started my career in investing, I started with an outfit called Bernstein. And Bernstein was and is one of the preeminent value investors. And what that means is, their approach is, we look for companies. It's sort of what I said earlier, the example I gave earlier, where something bad has happened and the stock price has fallen. We do our research. We figure out that the company is not going to go bankrupt. It will eventually recover. And in those situations, the share price usually overshoots. It goes down further than what the bad news really should make it do. And you find those opportunities. You outperform. You get a better than average return on your investment. We never called that behavioral finance, but of course it is exactly that, right? It is the bias of investors to overreact to bad news. So, sorry, again, a very long answer to a short question.
No, I think it's good to have this much detail incorporated. I think it's very interesting that, and we've seen this with other people that we've interviewed, that behavioral science, or the teachings of behavioral science or behavioral finance, whatever field you want to put after the word behavioral, has been around for a very long time, but has just been not labeled as such. So I'm pretty sure there were people who were behavioral financiers, maybe 50 years before behavioral economics or behavioral science was even remotely in the picture. And it's fascinating to me, because there's been a lot of resistance to behavioral economics coming up, especially, economics as a field was quite resistant. I mean, when are they not, But like this stuff has been around for ages, like decades before anyone had a label for it. And it's just cool to see that it's the same for the world of finance, for behavioral finance, which is really cool. And it makes me happy. Behavioral science has been undercover for so long. Now we will very sneakily take over the world.
That's right.
Yeah. We've got our behavioral scientists in all the institutions just ready to rise up.
Yeah.
Right, exactly. And who wrote this? I think it was an essay, "The Death of Behavioral Finance." Do you remember this? Well, it was a bit of a tongue-in-cheek piece, because it was one of the was Kahneman or Thaler, one of those one of the fathers of behavioral theory, because the argument was give us another 10 or 20 years and it'll be so mainstream that we can drop the behavioral because it'll just be finance, right?
Sure, yeah, we've heard this argument before that we're going to become so mainstream that we are effectively out of job. So we should probably specialize in something else. Maybe it's time I go into law, Wim. Any suggestions?
Yeah, exactly.
Yeah. So I mean, the efficient market hypothesis, though, this is still taught, right? Isn't that the case? Like, do we think that the tipping of the scales will be the moment where, people aren't just taught that the world works through this very specific, efficient lens? Like, why is it still being taught, do you think?
People are turning into their graves, Sarah, or just rolling around in their graves with that suggestion. Just a whole bunch of economists going, nope.
Look, I think, in defense of universities and scholars, it always makes sense in my mind anyway, to teach a model that is based on some very basic assumptions. Sure. If for no other reason that it'll make it a lot easier to then say, okay, now we know this is not how the world looks, how the world works, but if this was true, then this would be true. Now let's change these initial assumptions to get closer to the real state of the world. At least now we know how to then, deviate from sort of the theoretical outcome. So I think that's a good reason to continue to teach efficient markets. As sort
but
of.
Maybe it shouldn't be taught as the default perspective. Everything seems to revolve around.
It's been a long time since I've been in university halls. I don't quite know what they say. What I find very interesting is that University of Chicago, kind of the mecca of efficient markets, is also one of the main centers of behavioral finance, right? So
yeah. It's an interesting combination for sure.
Right. So they, and which actually, I'll plug my alma mater here, but it shows how that place is. Their guiding principle is, we're here to have open and honest debate, not to have, one truth that we must tell everybody is the truth, right? They really believe that, and this kind of actually shows that, I think.
Yeah, fair enough.
So
then I'm curious. So as a last, almost say closing question, what do you think the future is going to be like for quant investing? Like, what is your idea? Where are we going to be in 10 years?
I'll give you an answer that's sort of a little bit contrary to everything we've been discussing.
Okay.
So one of the trends, in spite of everything that we've just discussed, one of the trends, the big trends of the last 10, 15 years, has been a move towards passive investing. So this is, we've kind of danced around, we haven't mentioned it, but it's kind of implicit in everything we've talked about. So the alternative to trying to pick stocks and do better than average is to say, I'll just, sort of buy a fund that has a little bit of all the stocks traded on the market, and I'll be guaranteed to get the average market return. We call that passive investing. And for investors, it's attractive for two reasons. One is generally those types of funds charge lower fees. They can, because they don't have to hire analysts to do work or a portfolio manager to do any work. They could just, it's sort of very mechanical, right? And two, it takes away the burden from the investor to actually choose, which fund. There are like 1,000 funds there. How do I know which one to buy? And if I buy the wrong one, the market goes up 10. I buy the wrong one, maybe it'll go down 10, instead of up 20. So
Sure.
It's very stressful, right? So passive investing has become more and more popular for those two. Actually, as a third reason, over the last 10, 15 years, the aggregate performance of active managers, of funds that try to do better in the market, has been relatively poor.
I see.
So you'll read, if you read the financial press over the last 10, 15 years, there'll be more articles saying, oh, the market went up 10, but yes, there were some funds that did 20, but the average fund manager only did 7, right?
Ah, that's not what we want.
That's not what we want, right? So now, I could go into, let me just go into for 1 second as to, why that is. Or there's not one reason clearly, but one of the things that has happened over the last 10, 15 years is that the market has been what we call relatively narrow.
Okay.
What that means is that out of 500 stocks, on average, the market's gone up 10, but that's really has been concentrated in 20 to 50 stocks.
Okay.
For an active fund manager, that is a much, much harder environment to do well in as compared to, the market goes up 10 because, 250 stocks have gone up 20 and 250 stocks have gone up 0, whatever it is.
Sure.
So the market, what we call, the market's been very narrow, that has not been conducive to active management.
Okay.
And so you've seen this move towards passive management. And there's also been the press, the popular press has always also been, as I just mentioned, with these articles, look at this, these guys, they charge you 2% and then they give you something that's worse than something you could get for, 0.2%. Why would you ever give your money to these guys, and so on and so forth.
All right.
So what that means for the coming 10 years, which was what your question was, right? Actually, ironically, the more that trend happens, the greater the opportunity for active managers to find mispriced stocks. Because the fewer people there are that try to figure out what a company is really worth, the more likely it is that it'll actually be mispriced at any given point in time. And so the bigger the opportunity to make an extra buck from finding those mispriced opportunities, right? Right. So because the passive managers, right? Passive funds, they don't have any judgment on how much any company is worth. Just, okay, here are 10 stocks. This stock is, they just buy them in proportion of their size. So, if what's the biggest stock in the U.S. stock market, it's Apple. 10% of the whole market is Apple. Well, 10% of my dollars go into Apple, whether I think Apple is expensive or not, right?
Yeah.
So there's no price discovery. There's no, I think it's expensive. No, I think it's cheap. Okay, then we can come to a transaction. So the more that happens, the more deviation from the true fair value you will actually get. And so this is my prediction. Your question, what's going to happen over the next 10 years, we'll see that move towards passive management persist for a little while longer, but pretty soon we will see active managers starting to do a lot better. And then people will wake up and say, hey, what they've been telling me that active managers cannot outperform, maybe that actually isn't true. And you'll start to see a bit of a swing back. And then, we'll find an equilibrium somewhere at some point.
We hope. Well,
Right.
Well, absolutely fantastic. It was so lovely to meet you, Wim. Thank you so much for your time today. We both really appreciate it.
No, it was my pleasure.
As always, at the end of our episode, we give our guests an opportunity to plug themselves, whether it's sort of personal social media accounts or business endeavors. If the listener wants to keep up to date or wants to hear some more from you or investigate your work, where can they find you?
rosevalleyfunds.com. That's my website where the funds are described. You can sign up for a newsletter there. I write a monthly called portfolio report. So I write up how the portfolio is done. I write my impressions of what happened in the world, sometimes a bit tongue in cheek. I have a little bit of fun.
I always enjoy reading them.
So and obviously I look at the market through a behavioral economics lens. So I frequently comment on the press. The markets have gone up because X, Y, Z. That's the narrative fallacy and things like that. So
fantastic.
Thank you very much, guys.
Okay, so that was us talking to Wim. I thought it was a great chat. Sarah, what was the thing that stood out to you most?
Well, yeah, I obviously agree. Thank you, Wim, so much for coming on the show. We really enjoyed speaking with you. The thing that is stuck in my brain a bit that I almost think is quite ironic in a weird way is that this behavioral insight-infused algorithm works expressly because other people in the market will be making predictable errors as according to behavioral science. So it's harnessing behavioral insights, but only to the benefit of those in the know, if that makes sense. But
I guess doesn't make sense. How else would you beat the market?
Investing is a cutthroat industry, so you got to get ahead. But yeah, it was a new and different way for me to hear how, the sort of approach to using behavioral insights, rather than to help support people. Wim's not a villain in the story. He's very smart, but it was very interesting.
Yeah, for sure.
Very interesting.
No, absolutely. I think the thing that stood out most to me is that, first of all, he's only using mental accounting and prospect theory, which, I mean, they're huge theories to begin with. I think prospect theory has at least loss aversion and reference dependence in there, which I think are two key items when people try to buy and sell stocks. Especially because that theory then gives rise to the endowment effect, which is something, and the disposition effect, which is something that we see a lot when you look at stock trading. At least a very basic research on it that I've done, which is cool stuff. So I was perplexed that he only used those two, but I suppose they are a massive phenomena in the field. And another thing I think is quite funny is that Wim is predicting that we're gonna move into a quick area, like not like forever, but a quick era of passive investing before we dive back into appreciating active investing again, which I think is funny. Because if I'm being really honest, I don't make myself the illusion that I can beat the market. I think passive investing is intense enough,
Yeah, no, it is very strange, like the role of human beings in decision making. Because as Wim said, the marketing pitch for this algorithm, for this quant investing method, is that if it goes wrong, you're blaming a computer. So obviously, in 2008, when things did go wrong, this type of investing fell out of favor because, in a certain sense, there was no one to blame. And so you thought, well, why am I using this machine which isn't working? So in some sense, I guess you have to build up trust in people that these methods work, but also it's a bit of a scapegoat. You're not really putting your neck on the guillotine by getting people involved in quant investing, which is strange.
No, I think, beyond computers, I'm sure, if you screw over your clients by making them lose, hundreds of thousands or millions, I'm pretty sure they'll still hold you accountable, although you then, refer them to the computer and the algorithm. So I'm not sure. I can imagine that it seems a lot less personal, maybe a lot less biased, but obviously it's a human making the algorithm, although the algorithm is based on past data, which then actually reminds me of a conversation that we had with Rory Sutherland, where it's just like all the data that we have is based on the past, but it's not the past we're trying to predict. So there's some interesting stuff going on there, and of course the validity of applying past data to future data. But yeah, I think it's cool stuff. As Wim has already mentioned, he's only 2 years into his project, so still a work in progress because he needs at least 3 years of data. I personally have subscribed to his monthly newsletter to keep up to date with the Rose Valley Fund, because I'm really intrigued to see if this works and how it works, obviously. Also, Wim is a really funny writer when he gives you updates on the fund and the market, so I would recommend that 100%. And I think that is the end of the episode. Guys, I hope it was entertaining, educational, or at least thought-provoking. Let us know on our social media what you follow the episode. Make sure to check out Wim's work. I do think it's really, really interesting. And we hope to see you next week.
Yeah, thanks so much for listening, guys.
You're the dummy that don't believe in science. All your projects always be denying. You're the one I love, you're the one I wanna give